Well, stocks rose once more last week as big tech powered the market higher on Wall Street, with catalysts somewhat lacking besides that. Although the dollar continued to roll over, reacting to the dismal July jobs report that we had a week or so ago, while the pound advanced despite what was, frankly, an absolute shambles of a policy decision from the Bank of England. This week, the latest US inflation figures will be in focus, with some UK data in the mix as well, plus, of course, tariffs and geopolitical events in the limelight too. Plenty then for us to discuss on this week's episode of The Trade-Off. Without further ado, let's crack on with the show. So without wishing to tempt fate, it certainly feels like we're getting into summer markets, a relatively subdued end to last week, a subdued start to this week, and we're enduring our fourth heat wave here in the City of London as well. Joining me as always to make sense of everything that's going on is my good friend Ryan Littlestone from Forexflow Live and Forex Analytics. I'm very pleased, Ryan, to see that despite the sunny weather outside, you've got a nice, normal, conservative, restrained outfit on this week.
Well, given the heat that I was out walking in early on, you're lucky I've got a shirt on at all at the moment.
Oh.
But it is a bit...
No one needs to see that. We'll get taken off air. You might even get arrested.
Oh, charming. Okay. I'd like to see you down the beach in your string vest, but yeah, we'll speak about that another time, I think.
Well, next time you invite me down for lunch, that's exactly what clobber I'll be in.
And I will pay good money to see it.
Mate, I'm sure we'll have a queue of people paying good money to see that. In any case, let's crack on with Topical Thunder because we've got plenty to discuss this week. We do indeed have lots to discuss, and the first thing I want to talk about is that building right over your shoulder, Ryan, not the Royal Exchange, but the Bank of England. What an absolute mess it was on Threadneedle Street last week. We sat here this time last week and said, what we expect from the BoE, a 25 basis point rate cut and a divided MPC. Well, I don't think anything could have set us up for what we actually got. We did get that 25 basis point cut, bank rate coming down to 4% as expected. But the MPC very nearly accidentally left rates on hold. Now, what am I on about here? Lowering bank rate actually required 2 votes on the MPC. The first time policymakers voted, you had 4 voting for rates to be held steady, you had 4 voting for a 25 basis point cut, and you had 1 lone dovish dissenter, external member Alan Taylor, who preferred a 50 basis point move. Now, with that split, there's no majority for any policy action. If they'd have ended things there, bank rate would have been left unchanged. So the big man, Governor Bailey, decided that they would vote again, this time a binary choice between unchanged or a 25 basis point cut, and a 25 basis point cut won out 5-4. But what I think was interesting, not just was the fact that they were so divided they had to vote twice, but also the fact that, again, not only you had 4 hawkish dissenters, which was more than even the top end of market expectations, but 2 of those were the chief economist, Hugh Pill, and the deputy governor for monetary policy, Claire Lombardelli. Now, Governor Bailey being on the opposite side of the vote to those 2 who are the experts within the MPC on monetary policy and are, I see a little wry smile creeping onto your face there, Ryan, and who are involved in the forecasting process themselves, that's interesting, to say the least. Now, you had a hawkish vote split. I would argue you had a bit of a dovish statement because the BoE left in that line around a gradual and careful pace of future policy easing. They also took out the line that policy needs to remain restrictive for sufficiently long in order to bear down the risks on the risks of persistent price pressures. Now, hawkish vote, dovish statement. What do you think the forecasts were like? Well, they were hawkish because, of course, why weren't they? The Bank of England raised their inflation expectations. They now see prices peaking at 4% in the third quarter of this year. They also penciled in a faster pace of economic growth, and along with that, they penciled in a lower peak in unemployment. Can anyone make any sense of this? It's all just a big old mess, to be completely honest with you. Slightly farcical on Threadneedle Street. Although the one thing I will say is, I think both you and I have sat here in the past and levelled accusations of groupthink at the Bank of England. Well, certainly don't think we can throw that one around for quite a long time. At least there is some diversity of thought. Cables rallied a bit on the back of things. Knee-jerk hawkish repricing, pushing the pound up north of 134. Personally, I don't think it's a sustainable move. If you think of the long term, the BoE running a tighter policy, a more hawkish policy, that's a bigger headwind to economic growth. That's likely to lead to an even deeper black hole when we get to the budget in the autumn, a much greater degree of fiscal tightening, and therefore an even bigger headwind to the pound. So for me, this is a sterling move that is there to be faded. And well, I suppose the BoE are in as much of a mess as they ever have been.
Yeah, where do we start with this one? You say it's okay to have, a diversification of views, divergent views, but when individual members have divergent views with themselves, that's when you got to question what's going on. The one person you would have thought would have been nailed on for a 50 would have been Dingra, and she didn't. So, already you knew something was cooking and going awry. It wasn't hawkish, it was undovish. I need to correct you on that.
No. We're back on that, are we?
Hawkish means raising rates, and no one's raising rates at the Bank of England. So let's call it what it is, please. Let's do this properly. But yeah, it was a far more undovish vote. I was expecting that they were going to cut by 25, and it would be a decisive vote. 6-3, 8-2, even a 9-1. I thought, yes, they're going to go for a cut. Because they can cut now, the Hawks can then sit on the table or sit on the fence for a little bit longer. They might go into a little bit of a pause. But no, that 5-4 split, even after the Taylor shenanigans, made it a very undovish cut. And, hence why we've seen the pound react as it has, because it is them being restrictive. And they may have taken that line about restrictiveness out of the statement, but they've done nothing but talk about it ever since, including Hugh Pill in his latest comments. So here we are again. Yeah, what are they acting on? Inflation, always going to be more sticky. We've got the jobs data tomorrow, so that's going to inject something into it as well if those wages are hot. I'm going to talk about that in a moment. But yeah, they're fighting this battle, potentially weakening economy, hotter wages, inflation still sticky. Their mandate is inflation, although we know that they're going to act on the economy. And they're still well between this rock and hard place where they could see inflation going up. And even if they say it's going to peak, they've proved previously that they're not very good at calling that either. So, yeah, I align with you in terms of the fiscal side of things, the government side of things, and what the economy might do in the months ahead. And that's not very bullish. So, yeah, this rally in the pound may not last long.
Yeah, indeed. The other, I'd say two things on that is one, the BoE's forecasts are pretty ropey at the best of times. I would say right now, just tear them up because they're based on a market rate path that did this, and now that path is doing that because of the hawkish repricing that we've seen. So forget what they've written. The other thing is Hugh Pill, you mentioned the chief economist, he came out on Friday and said the Bank of England made a clear decision last Thursday. Well, Mr. Pill, if that's your idea of a clear decision, I'd hate to see what a messy one looks like. Anyway, enough ranting about that. You mentioned that we've got a busy week of UK data coming up, and that kicks off tomorrow morning with the jobs data.
Yeah, absolutely. So now Michael and I have finished ranting about the Bank of England.
For now.
Yeah, for the next 5 minutes. We can look forward to seeing how wrong they might be about everything as we get some decent data this week. Now, by the time you've seen this, we would have had out the latest jobs data. I say sort of because we'll sort of know the data because the data is still waiting to be fixed. So it's anything really. But
we're waiting for on that front, I think.
Oh, yeah. I might be retired by then. But either way, we're going to have to deal with whatever numbers they give us. Wage data will be for June, which the Bank of England may have known about, but it won't contain some of the public sector wage hikes that came in August, so that might still be waiting to filter through. We've also will have had the BRC retail sales number for July, so that will be an early indication of whether the good weather is keeping sales up. As I say, that weather's been good, but there's only so many string vests people like Michael can buy during the week to get through those Scorchio days. So we'll need to see whether that's keeping the things going along. On Thursday, we got our first look at Q2 GDP. Now, considering both April and May have been negative numbers, and June is expected to come in a measly up 0.2%, perhaps a flat quarter is the best hope we can get for this data. Now, Reeves's Q1 boast of having the highest GDP in the G7, I think lasted 3 days, was it, before we got the monthly GDP numbers after that, and she'll be looking to see if she can boast about that again or not. We also get industrial production and trade data, which will give us further insight into how things are ticking along. And obviously, the trade deal with the US will massively boost the latter. That's a massive bit of sarcasm in case you weren't aware. Now, as we said, the quid has been on the front foot since the Bank of England, and that's seen euro sterling back down to the bottom of my 86, 45, 70 zone, and better data will likely drive it down further. Now, still remain long, and we'll continue to add on dips, as I think there is more pain to come in the latter part of the year, but really only a move under the big 85 level will have me questioning that. So we may see a bit of a pullback if we get good data. On the flip side, if the data's bad all through the week, we're probably going to be sailing above 87 again.
Yeah, I think I would agree with you on that one. Obviously, the jobs data needs to be taken with a huge pinch of salt, given the data quality issues. And actually, I would say that you probably need to take the GDP number with a pinch of salt as well, because not for data quality reasons, but because we had all of these factors skewing the numbers higher in Q1, whether it be tariff front running, people buying houses ahead of the stamp duty changes, the national insurance changes that came in April. That's all then unwound again in the second quarter. So I think actually, and we mentioned this last week, what Jay Powell has been doing, which is looking at H1 as a whole, is probably going to give you a much better idea of how the economy is performing. And that is going to be pretty much flatlining, I would say, very anemic growth at best. I don't think any of this is going to alter the policy outlook in the short term, certainly given what we've just been saying about the BoE and how high the bar is for another cut. September is not a live meeting in terms of rates, although it will be in terms of the balance sheet. I'm also not sure that any of this is going to alter the narrative too much. We know that we've got a big amount of fiscal tightening coming in the autumn. We know that the third quarter has started on a relatively soft note. If you look at some of the PMI numbers that we've had, the pace of expansion, particularly in the services sector, has been slowing. So, yeah, is it going to dispel the doom and gloom around UK PLC? I very much doubt it. And if the pound were to find any sort of upside on the prints, then probably just gives another level for shorts to re-enter the fray.
Yep, and that's exactly what I'll be doing if I see any further dips in euro sterling. So I might up that juicy 86.10 level.
Well, there we go. Do with that information what you will. The trading jinx himself has spoken. Right.
Let's remind the viewers how many of our little bets have we won. I think we've had 3 and I've won. How many is it now?
Let's moving on.
Moving on, exactly.
Moving swiftly on to the US inflation numbers that we have out tomorrow, of course. The main highlight on this week's data docket. The reason why it's the highlight, of course, is because market participants and policymakers alike are continuing to try and gauge how tariffs, or indeed if tariffs, are being passed through in the form of higher consumer prices. Now, both headline and core inflation metrics are seen ticking higher by 0.1 percentage points in July. That would take the headline CPI metric to 2.8% on a year-on-year basis, and the core metric to 3% year-on-year. And if those forecasts are realised, not only would it be a 5-month high for both metrics, but it would also be the 4th month in a row where CPI, both headline and core, has been moving away from the 2% target. Now, I know the Fed like to focus on PCE, but PCE's been doing the same thing, and it's CPI that we've got coming out this week anyway. And with that in mind, I struggle to see how President Trump or any of the usual suspects on the internet, you know who you are, can run around saying there's absolutely no inflation whatsoever. I mean, to me, figures of that ilk are actually backing up what appears to be the view of the majority of FOMC members, certainly voting FOMC members, that right now their inflation is much further from their goal than the employment side of things. But of course, we will see how that shakes out between now and the September FOMC. We do have 2 CPI reports due before the next Fed meeting. Digging into the data, focus is especially going to fall on the core goods metric. That is, of course, where we will see any impact of tariffs being passed through. In June, which was obviously the last CPI release, core goods prices rose by 0.7% on an annual basis. Before anyone goes, that doesn't seem very high. That was a 2-year high in terms of core goods inflation, and it's likely to only continue moving further higher in the months ahead. Now, what's interesting is, despite all of that, which on its own you would argue is likely to lead to a more hawkish reaction function from the FOMC, we come into the CPI data with the market pricing about an 85% chance that the Fed cut in September and about a 1 in 3 chance that they cut 3 times by the end of the year. And to me, that feels far too aggressive. Yes, the July jobs report was not great, but can the Fed deliver that degree of easing when inflation is looking as frankly ugly as it is right now? I think the answer to that question could well be no. And speaking of Fed, obviously we do have the continued erosion of policy independence in Washington, D.C. The Council of Economic Advisors chairman Steve Moran was nominated to the Fed board by President Trump on Thursday, although I'm going to leave that one there because this is a family-friendly show, and I think any further discussion of that matter could lead us into very, very dangerous waters indeed.
Well, you'll be overjoyed with the news that came out over the weekend that Bullard is in the frame as well for the Fed chair. Oh, Bully Bullard, one of my favourites. He could flip around his mind. I could tell you, 1 minute he's a massive inflation hawk, and the next minute he's a deflation, whatever that is, penguin.
Dove, I think, is the word we used.
Well, I don't know. He was never quite dovish, so yeah, I'm going to call him a penguin from now on. But yeah, this is big data. This CPI data, whether they look at PCI or not, it is the first number of the new month, and it is coming after the markets had a big shift on the FOMC rate expectations after the NFP. So it's good. We're going to get some decent volatility around this, because if it is a super hot number, excuse me, much more than expected, much hotter than expected, then yeah, the market's going to reprice yet again, because it's going to say that, and as I think it was Fed's Muslim who said it as well Friday over the weekend, that inflation is moving out of balance again, while the jobs market remains in balance. So another rock and a hard place. You know, the Fed have got a dual mandate. Which one do they act on? Do they stay restrictive on inflation? Or if we see another bad jobs report, is that going to be enough to push them to a cut? And we've got to remember that the next jobs report is going to be uber important. I know we joke about it every month. This is the most important one since the last most important one. But the next one is really important, because if it holds up that jobs are coming off, then the market's going to get very dovish. But if it's a hot one, and you've got hot CPI, and now you've got hot jobs again, we're going to have a complete switch around, and maybe some in the market will even turn hawkish rather than undovish about the Fed, and we might get a few talking about hikes.
Yeah, I think we're a long way off on that one, but I do agree the labour market numbers that we get at the start of September, the August jobs report, is going to be pivotal in terms of shaping expectations for that September meeting. I think the one thing that a lot of people have forgotten, or seem to have forgotten, is that a number of times now we've heard from Powell and we've heard from other FOMC members where they've said that there is a risk of each side of the dual mandate, the goals coming into conflict with each other. I think we're starting to see that risk beginning to emerge. And the FOMC have also been very kind, and that they've told us how they're going to manage that. And they're going to look at how far each of their objectives is away from target, how long they expect it to take for each of those objectives to get back in line with target, and that will drive their policy response. I think for the time being, it seems very much to be the view that inflation is further away than unemployment or employment, whichever way you want to look at that, and that is therefore going to take precedence. Now, the problem we have, for want of a better word, is there are still 6 weeks to go until the September FOMC meeting, and markets in that period are effectively going to be, obviously we've got Jackson Hole in the interim, but until we get to Jackson Hole, markets are kind of running away with the idea that the Fed are just going to focus squarely on the labour market and forgetting the upside inflation risks and the potential for inflation expectations to become unanchored, which to me is quite a complacent view, I think.
Yeah, but then, what happens if inflation, let's say you've got two inflation reports. Let's say inflation is at 3.5% come the September meeting, and the next jobs data we see minus 150 employment and unemployment rate of 4.5%. What do they act on? Are they going to act on inflation, or are they going to act on the jobs numbers?
I would say they act on inflation, but I'm not on the FOMC, and I sense you disagree.
No, I really don't know. I do disagree. I think they
you ask difficult questions and then don't know the answers.
No, I think they do act on the jobs market because that is has a bigger effect. People losing their jobs has a bigger effect on the economy than perhaps inflation. Inflation just potentially squeezes spending. But if people are out of work, they're not going to have any money to spend anyway. So that in a weird way can take care of inflation to a point. So I think, despite they say what they're going to look at, I think a sustained trend lower in jobs, higher in unemployment rate will have them acting in rates more than inflation will.
Well, there we go. We'll see what happens on that front. We'll also see how many basis points worth of cuts Steve Moran wants, probably about 3,000 at this point. But anyway, we'll judge that one when it comes. We've got one more topic, which is geopolitics. Right.
Yep, we've got a big event coming up this Friday. So Risk is back on the platter.
I thought you were going to say you were taking me for a beer somewhere. That's a shame.
I would always take you for a beer, mate. You never know. I might pop up to town and surprise you. We've got Mr. Trump still shooting for that new Nobel Peace Prize. Hot on the heels of apparently brokering a deal between Armenia and Azerbaijan this weekend. Trump's been pushing for this Russia ceasefire. Now, last week things got moving when US envoy Witkoff hopped over there for a chat with Putin, which apparently, according to both sides, went pretty well. What wasn't good news is Putin's apparent demands for peace, which involves him keeping everything that they've taken so far. And that apparently, according to sources, had some US backing. But then we've had Trump's side saying that both sides will have to give up something if there's going to be peace. Now, obviously, the EU is going to make sure that they're being heard. So they'll be firmly in the Ukraine camp in any pushback against whatever Trump and Putin may agree on, or his ideas of peace. So Friday, the 15th, is crunch day for this Alaska summit, and when Trump and Putin get together. Now, whether Zelensky will be invited is another question. Trump's already said that he doesn't have to be in any meetings between him and Putin, so he might be out in the wings again, and maybe Vance will have another rant at him later. Now, one of the ceasefire ideas that's been touted around is both sides stopping aerial attacks. All these drones and long-range missile launches going on. But they said that would leave the ground offensive to carry on. So something like that is sort of a half positive step towards some sort of resolution. Now, I'm dubious about what could be achieved Friday, but we can hope that it's something that's going to lead to a full halt to hostilities. If we do get something positive, even if it's this aerial halt, then Risk might be buoyed by that. But I think the biggest price move might be if there's no steps forward and Putin just seems to be drawing things out. Now, your usual assets are going to be in focus here: gold, oil, the euro, Swiss, and also the yen. They're the assets are likely to be most effective or paying attention to this news. Now, I did look into this earlier. Because of the time difference between Alaska and the UK, say 8 to 9 hours, depending on GMT or BST, we might not get anything before the market close. And if it comes before the market close, it's a very illiquid time to have big news like that. So there is some big weekend price risk if that news comes after the close. So you need to be careful of that going into the end of this week.
Excuse me, a frog in my throat there. I think that's absolutely the right framing for it, to be completely honest with you. I mean, the market, outside of some of the crude benchmarks, obviously, the market has become, over the last year, 18 months, pretty much immune to headlines that have been going on in terms of, clearly it's a tragic situation on the ground, but from a market perspective, we've been focused on and we've been trading other narratives. I think the key is for markets, if there is concrete progress towards a durable ceasefire or truce or peace agreement, whatever they are able to agree. And by they, I mean the Ukrainians and the Russians, not Trump and Putin, because if Ukraine don't sign up to it, or if Ukraine and Trump agree something and Russia doesn't sign up to it, then it's not worth the paper that it's written on. But if the two parties involved are able to agree a durable truce in the conflict, it does allow markets to price out any risk that is in around escalation or widening that conflict or whatever it may be. And of course, given the thinner than usual liquidity that we see at that time of the week, whether the news crosses very late Friday or we react to that on the reopen on Sunday evening here in London, you do have the potential for an outsized move. So it may not be the sort of coast into the weekend that we would all hope for.
Yeah, exactly. And we all want peace, and if we get peace, as I say, it's going to be good for risk. For the euro in particular, it's I won't say it's a double-edged sword, but obviously euro being in close geography to the conflict, any solution there, you should see the euro gain. But then you might see things like defensive stocks coming off a bit, because obviously now there might not be a rush to keep providing arms to the Ukraine, although there will still need to be some restocking from Europe for everything they've been given so far, and that might apply to the US as well.
Yeah, and of course, even if there is, and of course, again, reiterate that second your hopes for peace, even if there is, NATO countries are still going to stick to the 5% GDP defence spending targets that they've all outlined recently. So, I don't think the headwinds facing any defence stocks would be anything more than a knee-jerk move lower, but certainly another risk to keep on the horizon towards the back end of the week. In any case, let's move on to our plays of the day. Right, so I'm going to be looking at the Treasury complex this week. I think it was a few weeks ago that we was talking about how range-bound the long end of the Treasury curve has been recently, and we're still in that range. We rallied down towards the 4.75% mark in the 30-year benchmark last week before sellers stepped in once more to defend the range that's really been in place since kind of the back end of April, very beginning of May. But with that in mind, and with Trump apparently going down the route of rather unorthodox economic policies once more, trying to exert his influence wherever he can, be that at the Fed, be that replacing the head of the BLS, whatever it may be, then it looks like the sellers are wrestling back control of proceedings. And you would imagine that selling pressure should persist, particularly when you consider how badly last week's auctions went, the 3, 10 and 30-year sales all tailing the when issued by a fair chunk. Now, obviously, a lot of this relies on a relatively hot CPI number, which would certainly help the bears out no end. But over the medium term, the logical target is 5% in the benchmark 30-year yield, or if you're trading a future, a move back down to 112 in terms of price terms would be the logical expectation. And the nice thing about this is it's very, very easy to know if and when you're wrong, because the range has been in place for so long and is now so very well defined. Ryan, I think we're all going back towards that risk that we were just discussing around Russia-Ukraine.
Yeah, I'm looking at a bit of a risk play this week. And as I said, we've got the RBA coming up and this US Russia summit. So I'm looking for really a low risk play that happens to sort of cover both events. Now, the RBA decision obviously will be known by the time you see this. So that part of the trade will obviously be largely moot. But I am buying some 66 calls in Aussie dollar for a cheap 12 pips in case they pulled another surprise and stayed on hold. I'll then obviously look at what's happened there to add to position and maybe at a lower strike if the RBA has moved in a dovish way and the price has come lower. Because what I want to do is trade this, have something on the table in case we get a positive result from this Friday summit. As I mentioned, that might not conclude until after the market is shut. So, that's open to gap risk on Sunday night. So if the RBA, if the RBA cut and there's no good news on Friday, then we're probably going to see Aussie lower. So using options, my max risk is limited to the option premium. So I'm not worried about any gap opens against me. So this is a way that options can be a good way of trading big events like this, particularly when markets are going to be closed for a potential period, because they can offer a cheap and safe alternative to just playing in normal spot prices. So that's what I'm looking at, some Aussie calls, just in case we get some risk positive and a surprise from the RBA.
Absolutely. Good stuff. Well, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forexflow Live and Forex Analytics for joining me. Thank you also to our producer, Kyriakos, for bringing things together as brilliantly as always. Do hope you've enjoyed the show. If you have, please do drop a like on the video. Leave a comment as well. Let us know how you're trading the markets or anything you'd like us to discuss next week. And that is when we'll be back with another episode of The Trade-Off. In the meantime, have a very good week ahead, and we will see you then. Goodbye for now.